Hello and welcome. In this lecture video, I'm going to provide an overview of bonds, talk about the advantages of issuing bonds, what bonds are, talk about the advantages and disadvantages of issuing bonds, also talk about bond issuing procedures, and talk about how bonds are traded. So this video is more of an introductory video to bonds, okay? So what is a bond? A bond is a liability. It falls under liabilities, long-term liabilities on the classified balance sheet. Okay. So a bond is a promise to pay a certain amount in the future. And then the other thing about a bond is the company that issues the bond is going to have to pay back the value of the bond, the amount that they actually received in cash from selling a bond, from issuing a bond. They're going to have to pay that back at some point in the future. And then they also have to make periodic interest payments. Those payments could be semi-annual, they could be annual, they could be quarterly. In the context of this chapter, we're talking about making semi-annual for the most part, semi-annual payments. So why would a company want to issue bonds? Well, let's talk about Mary Washington, okay? So Mary Washington is upgrading some of its dorms. So we have some dorms, the residence halls are a little bit outdated, so we have to update those. Updating those dorms costs a lot of money, a lot of cash, and we don't have that much cash sitting in the bank account. So what do? We issue bonds. Okay, we issue bonds, and so when we issue these bonds, other investors buy those bonds. Okay, creditors buy those bonds. And then what we actually have to do is maybe in 5 years or 10 years, we have to pay back the value of those bonds. So when we issue bonds, whoever buys our bonds, they give us money, $1 million. They give us $1 million to then what we can use to upgrade the residence halls. Okay. We have to pay back that $1 million in 5 years, 10 years, whatever the maturity is of the bonds. Okay. We have to pay those back. But the other thing about the bonds is that we have to make periodic interest payments. So when Mary Washington issues bonds, they incur two obligations, or any organization issues bonds, they incur two obligations. First is they have to pay back the par value or the face value of those bonds, also known as the maturity value, par value, face value of those bonds. They have to pay it back on the maturity date, which could be 5 years, 10 years, 2 years, 20 years, whatever it is. They have to pay that back. So if we issue bonds for $1 million, we get $1 million right now. We're Mary Washington. We can use that $1 million to upgrade our residence halls. And then in 5 years, we have to pay back the $1 million. So it's like a loan. But we also have to make periodic interest payments. So as I was saying, there's two obligations when we issue bonds. The first one is we have to pay back the par value. The second is we have to make periodic interest payments. Okay. The way that we determine how much interest we have to pay our bondholders, or the way Mary Washington has to determine how much interest they pay their bondholders, is they multiply the par value, which is how much they have to pay back on the maturity date. That's the par value. Okay. Par value times the interest rate. So par value times the stated interest rate. So with the bond, there is a stated interest rate. So it says we will pay 5% interest, or we will pay 10% interest. That interest rate is stated on a yearly basis. So if it said 5%, that would mean 5% of the par value every single year. That's how much interest we would have to pay our bondholders. So par value times the contract rate, what I just said, that 5%, that's also known as the stated rate or the contract rate. Par value times contract rate equals how much interest you have to pay your bondholders. Okay. And you have to do that either on an annual basis, maybe a semi-annual basis, maybe even a quarterly basis. It just depends upon how the bond is set up. Okay. In the context of this chapter, most of the time what we see is it's going to be semi-annual, so every 6 months. So that's kind of an overview of bonds. let's talk about some advantages of bonds. So bonds do not affect owner control. So bonds reflect a creditor relationship. So it's almost like we took a loan out from a bank. We owe money to our bondholders. We also owe them periodic interest payments. So we owe them the par value and then those periodic interest payments. But that creditor does not have an ownership right. They can't come in and vote out the board of directors. Okay, they can't do that. They don't have say in that. Okay, so that does not affect ownership control. The interest on bonds is tax deductible. Okay, bond payments are tax deductible, but dividends, which we know are payments to our shareholders, which reflects an equity interest, are not. Interest expense from the bonds reduces our tax liability. The final advantage of bonds is that they can increase our return on equity. So a company could earn a higher return on the borrowed funds that it pays in interest because it increases return on equity. So basically, if we issue bonds to upgrade our residence halls, and that's a 5% interest rate. That's the stated rate or the contract rate on the bonds. We have to pay 5%. Okay, but we use those funds to upgrade our residence halls, and by upgrading our residence halls, we can increase room and board revenue, right? Then what that means is that we're using that debt to then achieve an increase in room and board revenue, and maybe that increase in room and board revenue exceeds the amount of interest that we pay on our debt. Okay, so this would be similar to you taking out student loans. Student loans, you pay let's say you pay 5% interest rate on your student loans, but your college degree will hopefully pay out over time a more than 5% return. So in that case, you're earning more on your equity than you are on your debt. And so that would make sense to do so. On the other hand, it may not work out. So that's the disadvantage. I'm skipping down to the disadvantage of here is that when we look over here, well, I'm sorry, right over here, that should have pointed at number 1. But it could be that it doesn't work out. Well, we issued all this debt to renovate the residence halls, but still nobody comes. And now our return on that investment is lower than the amount of interest that we have to pay our bondholders. So it didn't work out. Up here, the return that we earn on investing in our residence halls, our return on investment, is higher than what we have to pay on our debt. Makes sense. Here, it may not be. So it's both advantage and disadvantage. It depends upon how well you use that debt to achieve rates of return. Okay. The other disadvantage of bonds is that it requires periodic interest payments, and then you also have to pay back the par value at maturity. So you have to pay back that par value. You have to make those periodic interest payments. And so that can be a problem if we have low cash flow, right? So we have to have the cash to make those payments. So when we look at our bond trading right over here, bonds are securities. We can purchase those on securities markets, on the New York Stock Exchange, for example. We can purchase bonds. Bond issue could consist of a number of different types of bonds in different denominations. $1,000, $5,000, sold to a lot of different lenders. After the bonds are issued, they could be bought and sold on the markets. Okay. Bonds, therefore, have a market value. How do we express bonds in terms of their market value? They are expressed in terms of their par, as a percent of their par value. So for example, if we have a company's bonds are trading at 102.5, what that means is that the bond is trading at 102.5% of par value. So if we have a $1,000 bond, that bond is trading on the exchange at 1,025. Okay. Similarly, if the bond is at 95, that means it's at 95% of par value. So if we have a $1,000 bond, this is the par value of the bond, that would mean it's trading at $950. Okay. In terms of bond issuing procedures, we have to get authorization. So that would be including the number of bonds that we want of authorized, par value, and then we also have to state the interest rate. This is called our contract interest rate. So we say, for example, we're going to issue 1,000 bonds. Each is $1,000 par value at 5% contract rate. Okay. We would have a bond indenture, which is that legal contract between the issuer and then the bondholders. We could have secured bonds, and in that case, with a secured bond, that would have specific assets that would be pledged as collateral. If the issuer can't pay the interest or the par value, then those bondholders can access some of those specific assets. Okay, might have to be sold and then get the cash. In terms of our bond debenture right over here, those are unsecured bonds. Those are just going to be backed by our general credit rating. And of course, those would be riskier than our secured debt because there's no collateral. A bondholder could also receive a bond certificate, and that would state the issuer's name, the par value, the contract rate, and then also the maturity date. A lot of companies reduce the costs of issuing bonds, okay, by not issuing paper certificates and also by using an underwriter. In the context of underwriting bonds, we would have a company would issue its bonds to an investment firm, for example, Goldman Sachs, investment banking firm. And then Goldman Sachs would then resell them to the public. Okay, that's what we're talking about right over here with underwriting. All right. That kind of hits the highlights. I have some other bullets, but the bullets that I just went over and that I discussed are the topics that I really want you to understand in the context for the exam. And I think that provides you a pretty high level of how companies issue bonds, what the par value is, what we mean by the contract rate. And also, I think it's important to understand why companies would issue bonds in the first place. And it's to get cash that they may not have for expansion, or in the case of UMW, to renovate residence halls. Okay. I'm going to end this lecture video now. And then in the next lecture video, I'm going to talk about journal entries for issuing bonds at par, issuing bonds at a discount, and issuing bonds at premium. Thank you so much.